Hello and welcome to Lecture 5. This lecture is on Bitcoin speculation. So in this lecture we're going to cover a couple of topics. First, we're going to cover the price of the Bitcoin. Second, some statistics that you should probably watch if you're considering investing in the Bitcoin. Third, the causes of volatility, at least some that I can identify for the Bitcoin. We're going to talk about financial products in general and then how they relate to the Bitcoin. And then finally some risks to consider. Okay, so let's go ahead and begin with the price of the Bitcoin. The first thing that you want to do if you want to determine what the price of the Bitcoin is in US dollars is go to the largest exchange and just read what the spot rate is. So let's take a look. On Mt. Gox as of April 19th, 2013, the current price of the Bitcoin is $120 per coin. The high today was $136, the low was $99.98. And we saw roughly 300,000 Bitcoins traded today. There was more transactions than just that. Okay, so I'd also recommend checking Blockchain's price summary. And this right here is a historical price index of the Bitcoin since May of 2012. And you can see in April and March and February, this is when we saw a massive price increase from about $14 per Bitcoin all the way up to, there we go, almost. Roughly around 266 it was its top point. And then it went down, had a dead cat bounce, and went back up to, let's see here, today's price of 120, give or take. And I've included a nice graph of the market price of the Bitcoin for you. So the first thing you do if you want to just see what the current price of the Bitcoin is go to Mt. Gox, and you can also look at Blockchain, and it'll give you a nice little graph showing you what the current market price is for the Bitcoin as traded on Mt. Gox, which is the largest exchange. There's a nice consequence of smart investors seeking arbitrage. If other exchanges have different prices for the Bitcoin, what people will do is simply purchase them if they're too low, and then resell them at Mt. Gox as quickly as possible to balance out the markets. If the price is too high on other exchanges, i.e., let's say CampBX has a higher price than Mt. Gox, then what people will do is purchase the coins at Mt. Gox and then sell them on at CampBX. And this actually causes the markets to roughly level out over time. Arbitrage-seeking behavior always balances out exchanges where the same product is being sold. So Mt. Gox, being the largest exchange, is a good index of what the exact price of Bitcoins will be. But you'll notice if you go to other exchanges, there's going to be a small differential of price. So for example, right now, Mt. Gox is at about $120. Last time I checked CampBX, it was $118 for a Bitcoin. So there was a $2 per Bitcoin differential. And what people will do is simply purchase in one exchange and quickly sell in the other if they can do that. It's a little hard moving money between exchanges very quickly. And so that's why we're seeing such a large price gap. If you were dealing with big stock exchanges like the New York Stock Exchange, for example, versus another stock exchange, you can move between these exchanges within seconds or milliseconds. So the price differential for the same product on one exchange versus the other is very, very small. It's generally within a few pennies, for example, not worth your time, or even an institutional investor's time pending transaction costs. All right, so if you're going to invest in the Bitcoin, besides just looking at the price itself, there's a whole host of statistics to look at. First, you want to look at some summary statistics. So let's go ahead and do that. This is Bitcoin Watch. It's a very simple, very easy page to understand, and this right here allows you to see a whole bunch of stuff that kind of epitomizes the Bitcoin economy in a very quick snapshot. So you can see how many total Bitcoins are right now in circulation. There's 11 million. You can see the market capitalization of all the Bitcoins, which is obtained by taking the average of all the exchange prices and just simply multiplying it by the total Bitcoins in the economy. So right now the market cap of the Bitcoin in US dollars is 1.2 billion. You can see how many transactions have occurred over the last 24 hours. You can see the average, the average transactions per hour. You can see how many Bitcoins have been sent, the average Bitcoins being sent per an hour, and then blocks. If you haven't watched the mining lecture, I would go ahead and highly recommend doing that before watching this lecture. So you should know what a block is, and you can see where the current block count is, how many blocks have been made over the last 24 hours, the average block difficulty, the average blocks per hour, the difficulty, the next difficulty, and so forth. And then some statistics about the network hash rate, as well as the hash rate in terms of petaflops. Then you can also see the hash rate distribution. So these are major mining pools like BTC Guild, /50 BTC, Bitminer. Again, I'd highly recommend, if you have not watched the mining lecture, to do so before watching this lecture. If you have, then you'll understand that these are lots of people working together who have agreed to donate their computer time to, well, I should say exchange their computer time to a pool operator so that they can have a statistically higher chance of winning that lottery for the next block. And BTC Guild is currently the largest, Slush is very large, 50 BTC is very large, and so forth. And so you can kind of get an idea of who is in charge of the mining operation of the Bitcoin by this statistic here. So this is the very first place to look, in my opinion, for information about the Bitcoin. It gives you a really down and dirty, rough summary of everything that's going on in the entire ecosystem, and then you can kind of, from these statistics, get an idea of where anomalies might be cropping up. When you trade anything, when you invest in anything, usually the investor will first look at some general information, and from experience and special knowledge, be able to identify where certain bits of information are problematic. So the next thing you do is you go to blockchain's charts. Blockchain is probably the biggest chunk of information, the largest wealth of information for stuff about the Bitcoin that you can currently obtain. And they have specific charts on everything. We've already seen one of their charts on the Bitcoin price, but they also have charts about how many Bitcoins are in circulation, where the Bitcoins occurred, the market capitalization of the Bitcoin. Very briefly, it was over $2.5 billion. Now it's over $1 billion, 1.2. You can take a look at how many transactions, the number of transactions, the number of unique Bitcoin addresses used, the number of transactions per block, output volume, estimated transaction volume, market price. There are really just limitless sets of data. Even that notorious Bitcoin days destroyed metric you can actually look at. You can look at the blockchain size. It's almost at 7 gigabytes. It's right now at 6.5. It's nice that it has a pretty linear growth, and you can see that over time it's starting to actually accelerate in growth in comparison here. You can see the number of my wallet number of users. And there's really just a huge wealth of information here. And what I would recommend you do is you go to Bitcoin Watch, and once you develop a sense of how the Bitcoin economy works, how the Bitcoin markets are working, you've developed a speculative intuition. If any of these things seem to be a little out of whack, go to Bitcoin charts and start looking at particular charts. Another thing I would recommend is going to bitcoincharts.com. And this is a nice website because it lets you build charts. And it appears it's unfortunately down. Occasionally you'll notice that blockchain.info and Bitcoin Watch, along with Bitcoin charts, because of just the sheer volume of people going to the websites, will go down from time to time. But I'd encourage you to go there. The link will be in the PDF associated with the lecture. And you can also just simply Google search it, Bitcoin charts, and you'll get it. It's the second or third result. But it's a really nice website because it gives you some beautiful graphs to look at. Okay, so one of the first things that you'll notice if you see anything about the Bitcoin is that there are massive price swings, and we call that volatility. It's a very volatile market. So if you think about markets that are low volatility, think about things like banks. Prior to the fiscal crisis of 2008, for the most part, banks were very solid, steady, stable institutions. They were, historically speaking, the people that wouldn't be very exciting. They just lend out money, people pay them money back, they make a predictable amount, they grow by a predictable amount. They tend to merge with each other every now and then. But for the most part, banks, historically speaking, have been pretty low volatile until they started investing in complex derivatives and other products. But there are many markets, the energy sectors, like, for example, ExxonMobil, Shell, ConocoPhillips, BP, even when they have big disasters like the Exxon Valdez or the BP oil spill, for the most part, it really doesn't affect the companies long term because they have a predictable growth rate, that predictable way of managing their business, mitigating risk. So we tend to call those low volatility markets. And while they're enticing for people who want to put their money somewhere safe and build predictable retirement accounts, because of low volatility, they don't go down much, but they also don't go up very much. Whereas other companies like Microsoft, when it was first founded, or Apple, or Google, or Facebook, they tend to be very volatile, especially during the formative years of the organization, where the share price can swing $50 or $60 in a single year, or even a single 2 or 3 month span. It's pretty amazing. Even Apple, for its stability and size, has seen a considerable decline since its trading all-time high. A lot of people are saying this company is going to be the first trillion-dollar corporation. And for a time, Apple was even worth more than ExxonMobil. And now they've lost a large chunk of their share price. So it's a volatile market. So volatility is something that we as investors tend to think about on a pretty regular basis. Markets generally are discussed in terms of the amount of market actors and the amount of total wealth invested. Okay? And these two factors, the amount of market actors and the amount of total wealth invested, along with all the connectors of that market to outside entities like governments, if it's a commodity market, maybe how the commodity is produced, the weather, etc., combine together to give you a sense of volatility. Markets that are small in terms of their actors and wealth are usually called thin markets. Thin markets are very volatile. Markets that are large, like oil and gold, are by contrast very thick. And in fact, even with OPEC, for example, and oil, their effect on the price of oil is usually overstated. They can reduce supply, they can increase supply, but this will only have a short-term effect on the price of oil and just a couple of dollars. For the most part, even OPEC, for all of its power and scope and size, is unable to significantly impact long-term the price of oil, regardless of what they attempt to do. And it's difficult for any one entity or person to influence or move a thick market. That doesn't necessarily mean that thick markets are not volatile. Oil, for example, when before the fiscal crisis, traded at an all-time high for West Texas International at $140 per barrel, or give or take, and it crashed to nearly $40 per barrel within just a few month period. So it lost $100 per barrel value. It's significant. It's very significant. But for the most part, you can manage volatility in thick markets much better than you can manage volatility in thin markets, because in a thin market, a single entity can go ahead and sell, and that could cause a rapid, radical price swing. Or a single entity can decide to invest, put a few $1 million into the market, for example, and then all of a sudden it can cause a rapid rally. So a website I love to share is FinViz. And FinViz is really unique in that they do a couple of things. First off, FinViz is an aggregator of all the financial information you'd ever really want to know, but the equity markets, meaning the Dow Jones Industrial Index and the NASDAQ and others, and they have this cool thing called the 3D market map. Let me show you. And this is actually a map of the entire stock market that we tend to care about. And it's in three-dimensional terms. If it's green, it means it's gone up. And the further it comes out at you is the more it's gone up. So we looked at, and if you hover over a particular company, I guess you have to double-click them, you can actually look at the charts of that particular company. So this is up 40% today. And then they also tell you a huge amount of news and other interesting things. So FinViz is a really cool website. And I'm going to show you futures and Forex. So if you're ever curious about what is the price of, let's say, oil, with West Texas Intermediate, or let's say live cattle, or let's say platinum, you can actually look at the price of these basic commodities, including gold, silver. You can get long-term charts and other things. So FinViz is a really wonderful aggregator to give you regular financial information about basically anything you care about on the markets, including dollars. the price of dollar in comparison with gold and oil, in comparison with the yen, and Great Britain dollar, and so forth. Swiss franc. Over time, as the Bitcoin becomes more prevalent and more diversified and widespread, distributed across the globe, if it survives, FinViz will actually probably start carrying statistics. Financial statistics, for the most part, are measured relatively the same way. I'll show you a chart on FinViz. So let's go to futures. Let's go to gold, for example. And these are called candles. And how you read a candle, let's see if we can zoom in a little bit. Okay, so how you read a candle is that if it's green, this is where the market opened, and this is where the market closed. And if it's red, the market opened at the top, and the market closed at the bottom. So gold took a huge dip, gold went up, dip, up, and so forth. And FinViz is cool because you can actually take a look at any granularity you so desire. So this is, for example, gold, or as of today, from 6 p.m. to 4 p.m., where the price has been and how it fluctuates and goes up and so forth. I was going to show you this with Bitcoin charts. They have similar tools, but this is exactly the way it looks. Green is bottom to top, red is top to bottom, and red means down, green means up. These are called candlesticks. So Bitcoins are relatively illiquid as well, and it takes time as a result of that illiquidity to go ahead and divest your position. Divest is just a fancy word for saying sell off your position. So let's say I have 100 Bitcoins. To move those 100 Bitcoins at a market rate I would desire sometimes is difficult. Whereas if you wanted to sell 100 shares of, let's say, Microsoft stock or 100 shares of Google stock, because of the scope and scale of the markets and liquidity of the equity markets, it would be very easy to move that kind of position without having to what's called walk the book, which basically means that you'll start at some point, let's say $25 for the stock, and you'll be forced to sell maybe half or more of your shares at less than $25, maybe $23 or $22 per share, because some market specialist has noticed that someone is liquidating. So Bitcoins are illiquid, and the specialists in the Bitcoin markets are enjoying very large windows of profit as a result of providing what little liquidity exists inside the market. This tends to also create volatility, especially when large positions are liquidated. This is going to be basically the status quo for some time. Another factor is that we lack financial products such as options to manage risk and also build more sophisticated trading strategies. When you're dealing with the equity markets, so stocks or fixed income securities like bonds or futures contracts like oil and gold, generally speaking, there are a massive host of rich and incredible financial products that are engineered by very bright people who have prestigious degrees and make lots of money. And these products allow you to manage your risk and develop very sophisticated trading strategies. And we're going to discuss that now. So we usually call these financial products derivatives, and that's owing to the fact that a derivative means it's based upon something, it's derived from something. So a financial derivative is basically a product that is derived from an underlying asset. So for example, an oil option is based upon an oil contract on a futures exchange. So when you can either buy oil directly off a futures exchange, or you can purchase options that allow you to do something else. Derivatives allow traders, in a nutshell, to manage their risk and also to establish price floors. So wouldn't it be nice if you have made a boatload of money on the Bitcoin? Let's say that you purchased Bitcoins for $20, okay? And it went up to $266. Now, wouldn't it be a really cool thing if you could, for a very small sum of money, purchase a couple of options that say that you have the right to go ahead and sell those Bitcoins that you purchased back at $20 for $150 for 6 months? Okay, so that means you don't care at all about the volatility of the market underneath $150. it's of no concern to you. You now have a floor. So when the market fell to $50, even though everybody else was sweating, going like, "Oh my God, I've lost $210 from the height of the market," you're sitting there flying high, saying, I still made $130 per coin. I know exactly how much money I'm making minus the cost of the option, and you can do that. That's actually called a put option. There's an old nomenclature, call options and put options. Call for a ladder, you think the price is going to go up, so you give yourself the right to buy at a certain price point. And put options, you think the price is going to go down, or you want to stabilize yourself, so you give yourself the right to go ahead and sell at a certain price point. This is why options create stability inside a market. Generally speaking, well-built and regulated derivatives that people understand and people have done business in for quite some time, like binary options, will allow the markets to reduce volatility. A good historical account would be onion futures compared to coffee futures, and looking at options on coffee futures when there were no options on onion futures, and see the rapid price volatility that occurred in the onion market compared to the volatility that occurred in the coffee market. Most economists, most financial experts tend to agree that having financial derivatives is a really, really good thing for the stability of a market, and also a good thing for reducing volatility within a market. If the Bitcoin is going to survive as a currency that the internet uses, financial products must be constructed. The good news is Wall Street tends to agree, and venture capitalists tend to agree, and we've already seen significant funding going towards startup companies specifically focused on selling financial products to help reduce volatility and manage and trade risk. I included a link here because options are a very deep and intricate topic from Investopedia, and they have a nice tutorial on what options are, how they're used, what you can do with them. And after taking this tutorial, which is totally free, you'll have a much better understanding of options in general. Just think of an option, though, as like an insurance policy that allows you to either sell or to purchase a underlying asset at a certain price point within some sort of time scale. And there's a whole bunch of different types of options: European style, American style, and so forth. And I'm not going to go into that. This is something that you'll have to discover on your own. Use the Investopedia tutorial, and that'll get you started. And just kind of follow the news, and we'll see what people create for the Bitcoin market. All right, some risks to consider. The first thing is, with all investments, never ever invest money you can't afford to lose. If you can't afford to lose the money that you invest in the Bitcoin or in anything, then what you're doing is gambling. And if you win that gamble, then you're a happy camper and you can pay your bills. But if you lose that gamble, you ain't going to eat. You might lose your house or your apartment. So please only invest money you have to lose. When I invested money in the Bitcoin, it was money that I fully anticipated was going to lose. I didn't actually think when I first invested in the Bitcoin that it would have been this successful. Honestly, I believed it would fail. When I first invested, told all my friends this was a high-risk, high-reward investment. So I only invested a small amount of money, a small amount of my net wealth in the Bitcoin. You should do the same. It's still a very unstable currency. Remember also that the Bitcoin has yet to be regulated. In contrast with the oil markets or the gold markets or any futures or currency exchanges, there is very hefty regulation. There are very sophisticated regulatory agencies like the Securities Exchange Commission, for example, in the United States, that do nothing but try as hard as they can to create free and fair markets, especially with international contracts. And even then, there's still a whole lot of fraud and manipulation and other such things. So regulation will inevitably come as the Bitcoin grows, and we do not yet understand how that's going to impact the price of the Bitcoin. Some cases it may encourage many more people to use the Bitcoin, and therefore the demand will increase, and so the Bitcoin will become more valuable. In other cases, the regulations may become so cumbersome, or the regulations may treat the Bitcoin as something it's not, and in which case it ends up killing the currency, globally speaking. But it is a clock. If the Bitcoin lives long enough and continues to grow at its size, scope, and scale, even regulations will not be able to kill the Bitcoin within 4 or 5 years if it enjoys this growth rate. Another thing to consider is the people on Wall Street are very wealthy, and they're wealthy for good reason. They're smart, and they've been doing this for a really long time, and they manage cumulatively trillions of dollars. The whole reason why the top 20% controlling 87% of Americans' wealth does not destroy our economy is because of Wall Street. For as much as we malign them or hate them, they move massive sums of money around into new business ventures, into funding for existing businesses, to give loans to people. There's a lot of things that they do, and they're very bright. Okay, they're not necessarily the most honest and nice people, but they're very bright, and they're very good at what they do. So if the Bitcoin becomes tangible from their investment perspectives, they will put it into their portfolios. And so if you choose to invest in the Bitcoin, be aware that you're going to be competing against seasoned professionals with decades of experience and billions of dollars at their command. They will build very sophisticated models. They're also going to build very sophisticated financial products that will favor them. On the plus side, this will make the Bitcoin more legitimate, significantly appreciate its value long term, and also probably reduce the volatility. On the bad side, if you're going to compete with them one-on-one, they're probably going to win. So be very careful about that and take that into consideration. Finally, due to the thinness of the market, if an early adopter decides to leave the market, then it could collapse the price by triggering a panic sell. Think about this as a startup company. Let's look at Microsoft. When Microsoft was first founded, it had two people, Paul Allen and Bill Gates. Gates owned 64% of the company, and Paul Allen owned 36% of the company. So them together, 100% of Microsoft. Okay? So if Bill Gates was to leave Microsoft, and he has, today, the impact was relatively negligible. Even if Bill Gates was to completely divest and sell all of his Microsoft stock, it may influence the price, and probably would, but he only owns about 10% of the company. So it will reduce the share price on the short term, but over maybe 6 months to a year, the share price will come back right up to right before he sold it, because the fundamentals of the company are still sound. The company doesn't need Bill Gates anymore. But if Bill Gates was to have left, let's say in 1981, there probably would not be a Microsoft today. It would be dead. Let's say that Bill Gates decided to leave the company right after the IPO. As soon as he was legally allowed to sell his shares, sell 100% of them and leave, there probably wouldn't be a Microsoft today. So these early adopters in this experiment, the Bitcoin, they have to hold on to their Bitcoin shares or spend them for commerce. They cannot go to the exchanges and liquidate their entire holdings, because if they choose to do so, this would likely trigger a panic sell. It would cause the Bitcoin a significant price reduction that would take months, if not years, to recover from. So if they care about the currency, they have to hold on to it. What's the part of the brilliance of Satoshi, though, as a kind of a counterpoint to this caveat, is that Satoshi engineered the system so that the early adopters would have every incentive to hold on to the underlying asset. Just like Bill Gates, when he had the IPO, said, no, I'm not going to sell all my stock, I'm going to hold on to it, because he knew that Microsoft's best days were ahead of it, ahead of the IPO. The early adopters know that if the Bitcoin survives, its best days are ahead of it as well. It could obtain thousands of dollars, if not tens of thousands of dollars per coin in value. So for the most part, all those who seem to be holding the largest shares of Bitcoins have yet to liquidate them. Yet, let's say for some bizarre reason, one of them, or maybe a very valid reason, one of them says, I'm done. That could actually conceivably destroy the current all-time highs that we've seen in the price and reduce the price of the Bitcoin to $10 or $15. Meaning if you invested at the $120 price point, you may have to wait for several years, as you've lost 90% of your value, for it just to even recoup the original value that you invested in. Okay? There are many other risks to consider. But I don't think it's really that necessary to mention them, other than saying this is a very risky experiment. And when we say high risk, high reward, we mean it. If you had invested back in 2009 in the Bitcoin or 2010 in the Bitcoin, you'd have either gotten them for free or you've gotten them for pennies on the dollar. Now they're worth several $100s. It could go away due to regulation. It could go away due to a variety of other features, or perhaps a new cryptocurrency that solves some of the flaws that the Bitcoin have been discovered to have. And in that case, well, everything you've invested will go away. Or the Bitcoin could be here to stay, and within 4 or 5 years go to $1,000 or $10,000 per coin in value. So that's kind of the risk. And so it's up to you to decide if this fits into your investment portfolio or not. What I won't do is tell you how to build models or use some of the charts that I've shown to invest your money. Number one, if I was an expert in investing and I was an expert in trading currencies, I wouldn't be teaching this class. Those experts tend to make hundreds of millions to billions of dollars every year for Wall Street. And so they live very cushy lives doing that. So I'm not an expert, and I never intend to become one. It takes decades of knowledge, experience, and just getting beaten up with and losing other people's money before you can claim that mantle. And even then, you get bad at it at some point and have to leave. Number two, I'm not going to go ahead and advise anyone who's looking at this for a long-term investment opportunity to currently invest in the Bitcoin. I would recommend that if you wish to involve yourself in the Bitcoin as a investment vehicle, not a currency, that it's really good idea to only invest less than 5% of your total net worth. Please don't invest anymore. We have yet to see regulations come. We have yet to see the financial products come. If regulations are good, financial products are solid, and Wall Street begins investing itself, then I think the Bitcoin will be a tremendously good investment opportunity, a very good long-term growth opportunity, because that's an indicator that the Bitcoin is, number one, here to stay, and number two, that the governments are okay with the Bitcoin. In which case, because it's a deflationary currency, it does have to appreciate in value, and it's something that you'll probably see a very good return upon. But I would not recommend investing in the Bitcoin and at this point with more than 5% of your net assets. One last thing I will mention is that if you are interested in investing in the Bitcoin as a day trader or a speculator, go ahead and let me know, because I have considered working with the community and working with a couple of traders that I do know who do this for a living, of creating additional content to discuss some of the things that you would have to do not to lose your shirt. Again, I'm not going to tell you specifically what to do to make money, more what you have to do to avoid losing some money or covering yourself, similar to what I would advise somebody in the Forex markets. Okay, well, that's all I have for you on Bitcoin speculation. I hope this answers a couple of questions. To do a brief recap, we covered the price, the statistics, the causes of volatility, financial products, and some risks to consider. The price is always available and easy to find. It's on Mt. Gox. Go ahead and look at the summary statistics first and work your way down using blockchain.info. We discussed volatility and some of the causes of it, specifically thin markets versus thick markets, and the fact that we don't have financial products to go ahead and manage risk at this venture. So the Bitcoin market is anticipated to be highly volatile. And then we also discussed a great deal of risks. Okay, well, that's all I have for you. The next lecture is kind of a wrap-up of our course. It's going to go ahead and discuss what I believe the future of the Bitcoin will be, and that's my opinion. It's not fact, and we'll find out if I'm right or wrong. And then also where the Bitcoin could go in terms of its price if it becomes certain things based upon the utility it assumes. Well, thank you for listening, and have a wonderful day.